G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Here we are for Property Finance Uncut, December 2022. The Reserve Bank of Australia, we just heard out, has upped the official cash rate by another 25 basis points, taking it from 2.85% to 3.1%. Not good news as we come into Christmas. I do have some good news. It's not going to happen next month because they don't meet. So we've got a reprieve for at least 1 month on this rising rate environment. We're going to break it down. What does it mean? Joining me, Paul Glossop, CEO of Finni Mortgages, finni.com.au. Paul, how you going?
Very well, mate. Very well. We're probably in line with what we expected to happen, to be fair, when you and I chatted only four and a bit weeks ago. So it's not unexpected, but for many going into Christmas, it's probably not what they wanted to hear.
Mate, it's not what they wanted to hear. And we've been calling this. I reckon I've probably mentioned it about 10 times now when people ask me what was going to happen in December. And I said a 0.25% increase in the official cash rate. I think the banks have been listening to me because they've been saying the same thing. Only Commonwealth Bank said probably 0.25, but maybe nothing. Who knows? But firmly in this rising rate environment, the mail is, Paul, expect probably another 50 basis points in the early part of next year. Everyone with a mortgage, I think for every $500,000 you have in mortgage debt, you're probably in for about another $75 a month in interest repayments as a result of the 25 basis point rise. That's going to hurt a lot of Aussies as we move into Christmas, Paul, particularly those with big mortgages.
It is to a degree, mate. I mean, it depends, I guess, is kind of the scenario here. And we've spoken about this a couple of times where we're coming into what is this fixed rate to variable rate cliff. And we spoke about there's probably three main big wedges of people or cohorts of buyers or owners of property and owners of debt who are going to either feel the pinch immediately, feel the pinch in maybe 6 to 12 months, or feel the pinch in maybe a year or two. But irrespective of when, they are going to feel the purse strings tighten. But this is probably the time, as we've talked about, that really everyone needs to start understanding what those dates are and what they can do about it.
Yeah, so it looks like the official cash rate will probably, in the market's pricing this in, is what's coming out this last couple of days, finishing about 3.6%. Paul, from what I'm hearing, there's already a lot of people hurting around these interest rate rises. A lot of data hasn't flown in yet. The next time the Reserve Bank of Australia meets is the first Tuesday in February 2023. And I reckon there's going to be 2 good months of data then to see what the impact is. It's not going to stop the Reserve Bank from raising rates a little bit more. Those people with mortgages, Paul, I'm sure it's the same old drill. What do you do about it?
Yeah, well, I mean, this is the as you said when you opened, mate, we've got a reprieve guaranteed for between now and the 7th of February. So the reality is at this stage, there's nothing that's going to happen between now and then. There'll be a few rates passed through by the banks from this, but what can they do about it? Well, this is a time where you need to get in touch with your broker to figure out what you can actually do about it. Because one thing's for sure is that when your rates go up, your borrowing capacity goes down. And that also includes the ability for you to extract equity from properties which you may already own, your principal place of residence, other investments. So if you're going to be able to get something out of your existing asset, i.e. refinance it, extract equity, do something else with that equity, which unequivocally will still be there if you bought that property 18, 24 months or previously ago, that is what you need to spend your Christmas holidays booking in a time to actually get that discussion underway.
So for a lot of Australians, this is the highest cash rate in 10 years since 2012, Paul. That's going to become a rude shock to a lot, if not most. Borrowers have never been in an environment like this before. It takes the sort of average discounted mortgage now from about 3.45% to about 6.55%. So big jump in interest repayments for a lot of Australians. Good news is that Aussie balance sheets are still pretty strong as a result of COVID-19. It's getting eroded very, very quickly. Already belt tightening is happening. Where would you be concentrating on tightening up the family budget, Paul, if you're thinking about keeping an eye on the bottom line?
Mate, it's a good question because I think there's some of the things that a lot of people now have to really start considering. Before I answer that, though, I want to probably take us back to your comment that you just made, is that this is probably the highest rates that most people have seen in a decade. I did a bit of, searching as to what price equivalents were 10 years ago in a couple of key markets, which I'll refer to Sydney for today. We might do February, might do another major market. But if you're in the heady heights of Mossman, the average house price in Mossman right now sitting a touch under $5 million, 4.8 odd million dollars. 10 years ago, when the rates were the same as what they are now as of today, the last time interest rates were where they were today, what do you think they were, Phil, as a bit of a trivia punt question for you as the property investment guru?
It's got to be depressing, I reckon. Median or average? Doesn't really matter.
Median. Let's go median, because there is some variability in that market.
In Mossman in 2012, 1.97 million.
No, you're not bad. It was about 1.7. Not bad at all. 1.7. Now, if we look at that as obviously a very exclusive and very, very tight market, it always been a very pricey market. We go back to markets. Let's go to the southwest of Sydney in Campbelltown, which was obviously and is still a very much a gentrifying fringe market to Sydney. Current house price there, average, you're talking around about $704,000. 10 years ago, Phil?
Oh, I bought a place.
I know you bought some property out there 10 years ago too, so you're probably closer to these numbers than most.
Ambervale, which is a suburb of Campbelltown, I probably paid about 280 grand for it. So I reckon the median price back then was somewhere between 270 and 290.
No, not bad. About 305 to 310. So again, doubled in that time. But it goes to show all that water that's gone under the bridge. Obviously, there's a fair bit of inflation and price increases of cost of living and people's increase in wages, etc. But that is a bit of fun facts, and there's a bit of that going on in every market.
I'll give you a hot tip. Wages haven't doubled in 10 years for people who are buying and living in Campbelltown or investing in Campbelltown.
No, they haven't.
But interest rate repayments are a lot bigger. And this is the key now. It is a game of finance if you're investing in property, if you're an owner occupier. Irrespective of where and why you hold debt, you want to have the cheapest, most effective rate and effective product you have available. We've spoken about this before, Paul. No doubt, if you reviewed your mortgage, there's a good likelihood there's a better product available for you at a better rate or better conditions or better terms.
Right, and that exactly answers the question you asked before. We took a little quick trip down memory lane. Is what can people do when you're faced with essentially if you're holding a $750,000 mortgage, let's say, as an owner occupier, the difference between 8 months ago and now is the best part of $20,000 a year net that you need to find to make the equivalent repayments. If it's $500,000, it's more circa potentially around 15 odd grand, and if it's $1 million, it's maybe 25 grand a year net. The reality is most people haven't seen those pay rises, but there's two things. One of which is your rates, going back to that aspect of where your rates sit, the differences in variability. For owner occupiers at 80% LVR, there is still certainly plenty of lenders out there, mainstream Big Four, as well as Tier 1 lenders who are in that 4.7 to 4.9% interest rate for an owner occupier, sub 80% LVR. Investors is about 4.8, 4.9% if you're a new customer. So there's the ability to get into that space. Even on the commercial rates, if you're sub 75% LVR buying as an investor, you're still circa sub 5.5%, even with this rate increase. And if you're an SMSF owner, as far as an investor, be it commercial and or residential, you're talking around that 6.3 to 6.4%, again, sub 80% LVR, which vast majority of owners, and this isn't where the issue will lie for the majority of people, the actual LVR is going to be okay for anyone who's bought more than 2 years ago, because ultimately you've seen the growth that's come. And although it's tracing back a bit, there's still going to be plenty of actual fat left in majority of people's loan to value ratios position. The other component, I know you get a lot of investors listening to this as well, mate, is that where people, and I'm finding this a lot more too, is that when we're doing reviews on mortgage applications, is that people are asked the question about what are your current rents? And our brokerage team will also do a bit more of a background dig on what your actual market rent should be versus what the rents that people are achieving are. And there is some big discrepancies there too. So a lot of people aren't realizing that they're leaving a lot of their serviceability as well as just genuine money on the table. We've seen in some cases 20% increase in rent. So if you haven't had that conversation with your property manager as an investor right now, then that is the other thing that I'd be getting busy doing over the next month or two.
That's a good point. Probably there's two. I reckon there's two areas which are undercooked at the moment. That is people who should be doing a rent review, because there's probably a bit of fat there. You got to consider vacancy rates right now. Do a rent review. I'd also be doing an insurance review while you're doing that, because a lot of people are underinsured at the moment, where their replacement value to rebuild your house, owner occupied or otherwise, is different. What I have heard, Paul, and maybe give some insights into it, that some lenders are starting to view rental income differently, where rather than just doing a 50% discount on any rental income, they're considering it. They're giving you a greater percentage of the rental income as a way of addressing your serviceability. And that's on the basis of rental vacancy rates are so low, the likelihood of not having a place rented right now is pretty low. So that's increasing serviceability for some investors, despite the fact that rates are going up.
Mate, it's a brilliant point, and it's probably something that's flown under the radar a bit over the last month or two. Is the fact of the matter is, let's say hypothetically you earn $1,000 a week in rental income, you might have 2 investment properties as an example. Most of the banks have been shading that by probably 70% they'll take of that total amount, maybe 80% in some cases. So in that same instance, they'll actually service $700 or $800 a week. A lot of those lenders are now looking at more like 90% of that total income they'll take. So in that instance, you're talking another $100 a week on minimum on that rental income, or $5,000 a year in your serviceability. So that goes a long way when you're saying that's only been a change in the last month or two. And people say, okay, well, there's been rate increases that erodes my serviceability. But if you look at under the hood, and a good mortgage broker will know, hey, there's this lender now who's actually servicing your actual rental income at a higher rate, then you're actually able to then increase your servicing as opposed to decrease it in some of these instances.
So we're at 3.1% now, Paul. 8 consecutive rate rises, the highest in 10 years in terms of the official cash rate. Market's telling us things will cap out at about sort of 3.6%. And that's come back a little bit. Sort of 2 months ago, they were sort of calling the market being, the market, those people that sort of look at this sort of stuff, smart boffins that sit inside of banks and economic institutions, were calling it was going to cap out somewhere in the low 4s. So 3.6. So there's still likelihood of 50 basis points, whether it comes in 2 tranches of 25 basis points or one big hit in February or March. I don't know. But when you're doing your sums, you should be pricing in at least another 50 basis points, potentially 75 basis points for where this market's going to tap out. Do you agree?
I do, mate. I do. I think, look, it's a safe way to do it. I mean, the reality is most lenders have that 3% added on to your serviceability anyway. So whatever you're borrowing at, they're going to service you 3% higher. Now, if I'm a betting man, I'd be thinking that might be something that might be also tinkered with in the coming 6 months. Is that extra 3% above where people are getting serviced is probably too high now. That might actually come down, which will no doubt probably stimulate a bit of the market a little bit further down the track. But that is something that people do need to consider, regardless of whether they get the money or not. Always make sure that buffer of circa 2.5% above the market rate. And if you're, like you said, mate, putting in another 0.5 on top of that 3.1, that's about where it is. And I think it's worth noting, mate, and I think you had a chat with Louis Christopher only this week, I believe, and I know he put out his boom and bust report, talking about 4 major instances or scenarios and what the likelihood of each of the major markets would be. And I know this is more about money, but it's also, for me, probably to give people a little bit more confidence as to where the markets are expected to go on worst case scenario, best case scenario, and somewhere in between. The reality is that if we're going to see a interest rate peak sub 4%, which what we've just discussed there will certainly be below 4%, and the current inflation markets, as far as the data is sort of now trending about 0.5, 0.7 less than what it was last month. If it stays on that trend, then by about 10 months down the track, we're going to be well within the target bandwidth of what the RBA is tracking, maybe a little bit below that. Now, obviously, we're not talking about forecasting where it'll be, but if it did trend that way, then the forecast from every single major market across Australia is that we're potentially going to see, by the back end of 2023, anywhere between 4 and up to 12% in certain major metro markets increase in prices by the end of 2023. So as much as we're sort of seeing now that prices have decreased in many major markets, the actual forecasting now, if it stays true to what we've sort of loosely painted that picture around, it actually isn't all that bad.
Well, some economic forecasters are saying, well, maybe there might not be any more rate rises. We're getting towards the top of it. And the RBA will keep a real close eye on this. The thing is, what do you do about it? Now, Paul, makes good sense to review your mortgage, health check, whatever you want to call it. And no doubt that the team over at Finni Mortgages can help out with that. Should you be extracting equity? Because a lot of Aussies got equity in a home right now. And to your point, getting ready for favorable buying conditions. And many people will tell you we're in those conditions right now. Should you be getting your money liquid? So if you are looking to buy, you can buy at that point in time and get a mortgage pre-approval so you can hit the ground running if and when you're ready.
You set me up, Phil. But mate, we've been harping on about this for
Leading
5
questions from a
months.
journalist,
They're
mate.
very
Sorry.
leading questions. Very leading questions. They're not the tough questions. These are the easy questions. But the reality is that you and I, we've been speaking about this. That this is what the clever, not only owner occupiers but investors are doing. But you and I both personally, I know within our own portfolios, have been discussing this for a long time. And basically, the back end of this year is that this is the high water mark that we've had as far as the valuations of property is concerned. If you're not pushing hard to get that money liquid and get it out so you're able to actually start getting busy towards 2023 or beyond, you're probably missing the best opportunity we've had over the last 4 or 5 years. And that's what I've spent my time with my brokers at Finni. I know you're doing the same thing, mate, is that personally doing that right now, because if I'm seeing an opportunity, now is the time to get that money out of those assets and actually liquid, ready to buy.
So lots of ideas there, Paul. I think the catch-all is be proactive, get involved, take control of your mortgage finance. Tell us what our listeners should be doing, mate.
Really simply, if they're looking to do that and they're looking to get an opinion of an investment savvy mortgage broker or someone who's going to really work hard to get their PPOR or their principal place of residence debt to where it should be priced, finni.com.au, there's a really simple button on our homepage which will take you directly to one of our investment brokers or owner occupier brokers within that same day and sit down to go through what's possible, what's not possible, best ways forward, worst ways forward. And we're literally available 24/7. So if anyone's looking to do it, they go down to the website finni.com.au and they'll be able to get those answers pretty quickly.
Paul Glossop, CEO, Finni Mortgages. Thanks for your insights, mate.
Thank you.